Welcome to the Gray Report. I'm your host, Spencer Gray, and joined by Matt Bosnagel, Director of Communications and Marketing here at Gray Capital. Well, if you're a multifamily investor, just are interested in real estate in general, active, aspiring, or you are already in the multifamily industry, your boots on the ground right now, doing deals, making things happen. The Gray Report is the podcast and YouTube show that was designed for you to keep you up to date on all the latest happenings in the multifamily industry. We're talking the latest research reports, data, where rents growing, how are rising interest rates affecting multifamily industry, trying to give you the right set of tools to make the best decisions in your business, whatever that may be. Again, we're doing this for ourselves, but we're also trying to help you just stay up to date. We're going to be talking about what's going on, what we're seeing in the industry, what the experts are seeing, opinions, commentary. Let's get into it. All right, a lot of great reports, Matt, on the Great Report this week. Fannie Mae, Fortune, Cushman & Wakefield, Redfin, and then a video that aired this weekend on 60 Minutes, which I thought was interesting. Interest rates, Fed. Yeah. I think we've moved beyond talking about inflation. Now it's interest rates. We can talk about the underlying fundamentals of the housing industry, why I may still be bullish in investing in multifamily, but this interest rate stuff, it's hard to figure out. It's moving really quickly, and I think one thing that a lot of people know is when interest rates rise so quickly, we could have a recession. So there's a lot of uncertainty out there, but outside of that uncertainty, how's your week going?
Pretty good. A lot of activity. Been a busy week, I think.
We've had a lot of stuff going on. We don't have anything going on. Should we do like a week retreat? Can we take a couple days off?
That's good. I'm going on spring break. I don't know.
Oh, that's right. I did see that. Where are you guys going?
We're going to Disney World.
That's right. So. You guys are going to Disney World. Yeah. I had my annual physical today. I was talking to my doctor about going to Disney World. They went to Disneyland recently, but we were talking about it. And another example of inflation. If anywhere has experienced inflation, Disney World is certainly the place. I've heard that it has not gotten cheaper.
Yeah, I got to check the exchange rate for Disney dollars. Do they still? I don't think they have Disney dollars anymore.
I don't. I haven't been. I haven't been in a while. My kids.
Maybe that's on the blockchain.
It may be. They've got all the political controversy down there right now, so that'll be fun. It'll be right in the middle of that.
I'll report from the scene.
Yeah, well, definitely interested in seeing how the Orlando housing market is doing. I mean, it's been on fire. I remember talking to a couple of housing experts when I was in Orlando last down for the National Multifamily Housing Council. Talking to guys that don't have a dog in the fight, but they're saying, man, Orlando, because of when things really start opening up, which they had been, but really they have been recently, man, that town's going to start booming because they're going to need the hospitality, the service workers, and they're going to have to pay them a lot of money to be there because they need them. They're charging $18 for your soda pop, so they can probably afford to pay somebody at least maybe $10-15 an hour to pour it.
Yeah, that's a really good point. Yeah,
$20 sodas.
We're gonna see some real big changes as this as a little bit of shift towards a service economy as people go and do things. It's going to be interesting to see how that shakes out geographically.
Absolutely. So I just want to jump right into the first report that we have here, which is coming from Fannie Mae. Matt, bring us in. What does Fannie Mae have to say? Fed raises rates for first time since 2018. So we were just talking about what does Fannie Mae?
So it really hits on the two big themes, I guess, of a lot of these reports have covered this week, which is housing and the Fed rising rates, and not just multifamily. Really, it's housing in general that they're talking about, and a lot of these reports are talking about as well. I guess the knee-jerk response I had to the headline, which is Fed raises rates for first time since 2018 as housing shows early signs of slowing. I get the picture, but like the reptile brain part of me thinks, oh, did housing cool down because Fed raised rates?
in 2018.
I mean, you know what I mean. I think that the cooling housing market, as depicted in this report, is pretty independent of the Fed raising rates. Just happening at the same time. And there's also likely some seasonality to these numbers, which we'll get into specifically. I think that we've just come out of a year that showed consistent high demand in summer and winter. So this looks more like things are settling into a less frenzied housing market where actually seasonality has an effect. Some discrete numbers. Existing home sales fell by 7.1% last month. Median home sales price decreased by 0.3%, and the number of new homes on the market went up by 2.4%, but is still historically low. I think outside of the Fed.
When are these? So when is the date on these?
I'm assuming that
January?
these are for January or February numbers.
Okay. Well,
I think
that would make sense. I mean, I'm sure there are people putting houses under contract in December, but you know, it's not exactly a lot of people taking
you won't see you don't see activity on either side. But that being said, that 2% is still historically low. And it seems like this is the case a little bit where the cure for high prices is high prices. Partly, I guess, seasonality, but it's almost a relief that prices aren't continuing to go up and up and up and up until you kind of can't breathe anymore. That would be alarming inflation. But I think that what we might see is a return to normalcy, something that you can predict, something a little less volatile.
Well, and that's what we've been talking about. Just we don't want to see the growth, and not seeing insane growth is not inherently a sign of, oh, well, it's a weak market now. It's just maybe we're returning to normal, because the same people who are saying that, oh, well, you see, there's a slight decline in home sales. The prices decreased by 0.3%. The housing market's crashing. Are the same people who are pointing to price increases as evidence of a bubble also. So it's like, but you can't have it both ways.
And when I try to point out that correlation doesn't equal causation with the fact that housing's cooling as Fed is rising rates, I still think that there's still a possibility that the Fed rising rates could cool off and reduce demand in housing as mortgages get more expensive.
It absolutely. I mean, it will. It will. But it's is it wholesale or is it on the margins? Just in a vacuum, rising rates, just like we saw back in 2018, it didn't cause a crash in the housing market. I mean, prices of apartments continued to go up, and we saw cap rates flatline, and then they continued to drop down. So it doesn't necessarily, rising rates in a vacuum don't. But what we're all concerned about is if the Federal Reserve moves rates so quickly to force the economy into recession to tame inflation, well, then it's not really the interest rates itself. They were more of the cause. But then it's the real symptoms of, well, I lost my job, or it's uncertain times. I'm not going to make these big decisions. It creates uncertainty. That's more the effect, not just, oh, well, my monthly payment's going to go up a little bit more.
For multifamily as a part of the economy, relative to the economy, there's really no reason to get out of multifamily. If multifamily is doing bad, then it's probably because everything is doing bad. And there's a case to be made that multifamily could be doing pretty well while everything else does a little bit worse.
I think that's a likelihood.
And that's a worst case scenario.
And I think the worst case scenario is we just see kind of flat, not a lot of growth. I don't think there's necessarily going to be price declines, although, anything's possible. We saw, negative oil last year, now 100, whatever dollar barrel oil. So, anything is certainly possible. But what I see is, potentially, I think very quickly, because cap rates are, a lagging indicator, because it's like what were sales like a couple months ago, but those prices were locked in like a couple months prior, because that's when like they went under contract. So the cap rates are a lagging indicator, and I think what we're going to see once we start getting cap rate reports that should start coming out after the end of this month, at the end of March, we're going to see a very sharp decline in cap rates. Cap rates that are going to be, in a lot of them, in the 3s, low 4s, even mid 2s. As crazy as that sounds, and then I can see them coming back up, but not above. So like prior in 2021, kind of average cap rates around 4.5%. 4.75 nationally. I can see it dropping down to even like 3s, which is crazy, but then bump back up to 4.5, 4.75, even 5.
So is it typically, now you you had the interview with Noah Stone, the thought leadership from Berkadia. Did he say that is that typical when interest rates go up, cap rates go down? Is that the typical movement, or is this, or would decreasing cap rates be more of kind of the reaction of the market?
The correlation between cap rates and interest rates are much less intertwined and correlated than people assume. Now, obviously, the spreads are, the spread is what the spread is, and as interest rates rise, that spread narrows, and the cap rate and interest rate spread, which is the difference between your interest rate, which should be lower, and then the cap rate, which should be higher, theoretically. What's that difference? Because if you're borrowing for really low, but you're getting good cash flow at a higher cap rate, that should, taking your business plan out of it, that should produce higher cash flow and income, theoretically. Now, not necessarily, because you could start a low cap rate and add value and increase rents and get cash flow up, but just looking at cap rates and interest rates. Conversely, if interest rates start rising and cap rates are the same, that spread narrows. And if cap rates even decline further and interest rates rise, that would significantly, limit your ability to get cash flow day one.
Yeah.
We saw incredible large interest rate cap rate spreads in the middle of the pandemic and through 2021 because rates were so low. Rates, you could lock in rate at 2%, 2.5%, very low, but cap rates were still 5%, 4.5%.
Yeah.
But now if rates are 4%, 4.5%, and your cap rate's 4.5%, all of a sudden you have almost a zero spread, or you could even have an inverted cap rate interest rate spread, which I don't believe. We'll have to go back. I don't know. I'm sure people have certainly bought inverted cap rate interest rate profiles, but on a national average basis, I don't believe we've seen that kind of inversion of interest rates being higher than cap rates, and that would be to a point where cap rates are going to have to move up to some degree. But that but cap rates, they're obviously directly correlated to prices, but it's not the only other variable. So you have your net operating income. And so with rent growth, that's the other equation, is how much rent growth are we going to see? How much more rent growth is going to be absorbed? Or if rent growth is going to significantly slow down. If you have high rent growth, but you have a low cap rate, well, your yield on costs, which is kind of like your cap rate once you've bought it, well, that can rise. And so you may start at a low number, but your rents are rising so much, your income's rising, that you can make sense of it. That's how some people buy big value add deals at very low cap rates, because they know, I'm going to put so much money into it, I'm going to increase rents. There's something there. Yeah. But it'll be interesting, and we're also just inversions. We talked about this thing last week, looking at yield curves, between the 10-year treasury and the 2-year treasury, or the 10-year treasury and the 3-month treasury, looking at those rates, their relationship. And when they invert, again, it's not a good sign for the economy. People have less confidence in the future. Yeah.
Okay. Because at first glance, I would think that rising interest rates means maybe investors are less competitive, less interested in, because deals can't pencil. Maybe it'll be less, and so prices will go down, cap rates will go up. But it seems like also,
well, that's something that I think is worth talking about. Is that right now it's not necessarily that rates are more expensive or that rates are higher. It's that we don't know.
Okay.
That's again, we're in the middle of a couple transactions right now, and we had the Federal Reserve announced last week that 50 basis point interest rate increase, and that immediately moves what we would pay on a loan, because a lot of our loans are based on SOFR, the secured overnight financing rate, and it went from 0.05, where it has been since it was created, or since the pandemic, and immediately moved to 50%, or the 0.5%, half a percentage point. And then there's a lot of talk of, could there be 7 additional rate increases this year, which I don't think is going to be the case, but it could be. And then, so if we're looking at SOFR at 2%, which is crazy because the 10 years at 2% right now, we'll probably see an inverted yield curve But interest rates all of a sudden, from when they were mid twos up to threes last year, all of a sudden they could be in the 5.5%, 6% range. And trying to put a business plan together, it's where it's going to be, because lenders, we're also in an environment, so there's low cap rates though still right now. We have higher interest rates and low cap rates. So you're not having enough income to cover your debt service in the first year. So you have to go low leverage, or if you're going to go fixed rate debt, you're only getting low leverage loans and high interest rates. If you go floating, which can be incredibly dangerous in this environment, unless you hedge yourself with some sort of cap, but the caps that you purchase are really expensive right now. You have to buy these kind of third party almost insurance products to hedge your interest rate risk, and they have completely blown out because of the risk of rising rates. Because it went from being like, the rates probably aren't going to rise, but you're going to buy it just to make yourself feel good. But now it's like, oh no, there's a good chance that they will rise. We're pricing that in because it's insurance. So there's a good chance, like if you buy insurance on something that's probably going to happen, you're going to make you pay a lot for that insurance.
Yeah.
And that's complicating a lot of deals right now. There's still ways through it, and you have to be creative. And if you can do lower leverage for the time being, if you think the rates maybe aren't going to be that high, in a couple of years, you can get through it. But it's the uncertainty that I can see leading to a slowdown in transaction activity. I haven't seen any evidence of a slowdown in transaction activity.
That's what I was going to get at too.
Rates were also rose a week ago, so a week.
Yeah, that's kind of what I wanted to get to too. Is like there's still housing demand out there. The rents will still continue to grow. There's maybe the housing market cooled off a little for home buyers, but these 0.25 increase in the interest rates aren't going to really make a significant dent at this point. But investors are forward looking, so maybe that will.
I think that's a good point. Just like the 50 basis point increase, like that doesn't move the needle. That was already all priced in. That we already knew that. It's just what the future is going to be, and if we're not sure, and then for them predicting things, 3, 7, 5, 10 years in the future, good luck. But that's our job to make a good. Conservative assessment. But a lot of this is, we invest in apartments for like a lot of these reasons because of like the chance for inflation and all of it. But it's still part of why we're investing is, locking in, good debt and letting inflation destroy it. But if you are on the hook for, a variable rate loan right now, it could go all over the place and you could be in a bad spot. And I think that if you're not keenly, aware of that risk, you could see some people that are in bad spots. And again, to your point, the underlying real estate is doing great. And theoretically, if there is continued higher inflation, rents should continue to rise to offset that. But if we see some kind of stagflation with really high interest rates, but all of a sudden not a lot of rent growth, if you structured a deal the right way, you're fine. But if you structured it maybe not the right way, with a floating rate loan without a cap, you could find yourself, paying 6% interest, 7% interest, and you were only thinking you were going to be paying 3%, so your interest payment is doubled. That's a big chunk of your expenses. Cash flow gets sapped. Now, in a lot of these deals, and again, this is why we like multifamily, because even in those circumstances, you're not losing money. You're just not making a lot of money. So
a lot of this is like it's going to be a worst case scenario for everyone, but. Again,
so what do we do? What do you do in this environment?
It's hard to think of a reason not to invest and keep investing in multifamily because.
But how?
What is interesting, what you said is using less leverage. And that may be the way that people go, but that makes deals smaller. And it makes it a lot more difficult for people. A lot more equity to do things.
So I think lower leverage. I think because lower leverage reduces risk, higher leverage increases risk. If you can get fixed debt, so we're looking at lower leverage loans right now with fixed debt, so we can get fixed rate debt, which you're not getting great interest rates, and even on the fixed rate debt right now, if you don't think that we're going to have incredibly high rates for a long period of time, or you're okay with taking a higher interest rate on a takeout, you go with some kind of floating rate loan and purchase a cap, or like a bridge with a cap. Those are the only two things. But yeah, sitting on your hands and not doing anything is a choice in itself, as we've said.
Yeah.
I think the only thing you do is just you need to get with the right sponsor if you want to invest in real estate, because I think there's still an incredible amount of opportunity, and there will maybe some great opportunities to buy some great real estate, because people are going to be scared out of the market.
Yeah.
But how do you protect yourself? And I think partnering with someone that has the experience and has a good plan.
Yeah.
To do it.
You know, and for all 2021, it wasn't like the question wasn't, do I invest in multifamily? It was kind of where to invest. We were looking at everything. Now it's a little more uncertain. Uncharted waters, as they say.
Good point, Matt. Let's look at that, though. The housing market enters these uncharted waters. This is a piece from Fortune.
Yeah,
magazine.
I hinted at this when I was talking about the demand and these larger factors. But this is really puts a pin, and it really hits the nail on the head. And it's this quote here. It says, "We're still inside the 5-year window between 2019 and 2023, when every millennial born in the generation's 5 largest birth years will hit the all-important first buying home age of 30. Underbuilding in the decade following the housing crash means there isn't enough supply to match that cohort's demands. Even if higher rates price out some buyers, it wouldn't be enough to alleviate the underlying supply and demand mismatch." These are huge. We've said this before many weeks in a row. These are huge generational forces that you can't, 0.25, even a 0.75 rate hike is not going to erode these millions of people that are going to want to be living in a house.
Yeah, they want to buy a house.
To live.
You still need a place to live. And like what we're seeing in like Indianapolis is, someone's coming down from Chicago and they're selling their $3 million home, and they're looking at $1.5 million home in Indianapolis. It's the same size, nicer probably.
Yeah,
and they're like, oh yeah, I can pay a little bit more. That's fine. It's marginally different. And then historically, rates are still low. Even if we get all these increases and rates are up, 5%, that's far from unprecedented. That's actually kind of a long-term average. Now, the average has been decreasing, and I still don't think over the long term, rates are going higher. Rates are still going to go lower over the long term. I think in 5 years, certainly in 10 years, there's a higher chance of us seeing negative interest rates than 10% interest rates. But we got to deal with the short term now, because there's a lot of cycles in smaller cycles within larger cycles.
As much as everyone likes to make fun of how, Jay Powell said it was transitory, and now, he's saying it's not. That's kind of beside the point at this point. And if you're, listening to his rhetoric or kind of trying to piece together what might be his attitude and project on the future, it is of material importance that he's not treating it like transitory. He's not talking about it like transitory, and he's talking about kind of getting serious. I don't think that will mean a huge catastrophe or enormously increasing interest rates, but it is time to get real. You can't be deluded about this and can't, dismiss it out of hand. You just have to do different math now, and there are some things that may not work.
Yeah. They're going to try to take all the stops to quell inflation. I think they still have the opinion that once the supply chain bottlenecks get worked out, but like that's becoming a broken record at this point. You'd think at some point we get these things figured out, but still is seeming a problem. And then we've got the whole war in Ukraine is a whole other wrench in those gears, and it's beyond probably this conversation. But the possibility of a famine with like not enough food.
That's a good point.
With Ukraine, they're not planting wheat right now, and they produce a ton of the world's wheat, and Russia exports a ton of the world's wheat, and we're not buying it from them, and Ukraine's not making it. So and that's not going to hit the United States necessarily as hard, but it's going to hit poor countries, because the richer countries are we're going to stock up on food, price out a lot of the other countries, but we're going to see the price of all food go up and everything. And then we've looked at CPI again. We've been warning against, higher inflation really since the middle of the pandemic. We got into investing in real estate with the idea that there is going to be a devaluation of the dollar and money printing and inflation at some point. And we're seeing it. And we've done this defensively for ourselves, because we know how destructive inflation can be. What's not that we're rallying for inflation because it hurts so many people, but just more looking at we're looking at the weather, and we're trying to protect ourselves from the storm. We're not creating the storm. We're putting out the cisterns and the water collecting buckets because we're trying to protect ourselves. But the reality is, a lot of people are already being severely impacted. And it's not just rising rents; it's rising prices of everything.
There's a whole host of uncertainties. There's commodities. There's all the natural resources that Russia has a significant amount of. Russia and Ukraine are significant parts of the economy that could really almost affect it a little more than the numbers might imply.
It's certainly true. All right, Cushman and Wakefield.
Yeah.
The Fed finally lifts off what rising rates mean for commercial real estate. All right, let's keep talking about it, and let's see what Cushman and Wakefield has to say, Matt.
Yeah, this report is a little older than the other ones, but I really think that the perspective is a nice counterpoint to some of the scarier stuff that we were talking about just now.
That.
I think that this is more than here are the impacts. It also starts with some context, and it talks about how in March 2020, that's when the Fed reduced interest rates to near zero. Guess what they were before March 2020? They weren't at zero, so they've been higher than it is now before, and things weren't conflagrating.
There was a period in I don't know if in late 2020, kind of mid 2021, where rates were they were still zero, and I mean they were zero 2 weeks ago, where some people were thinking like, oh, we're just gonna stay here forever, and that's just not wasn't probable. We knew they had to come up.
Yeah.
And again, like I said, I think they'll come back down, but they have to come up to come back down.
Yeah, that's what. Well, and some of the commentary that I've heard is like, well, they're raising it now so they can lower it and spur it, so they have that tool in the future, which
almost makes me think that the again, because we're looking at a lot of different financing options, and one of them is using a interim bridge loan, call it a short term loan, call it like 3 years or so with a couple of years of extension, interest only, good interest rate, but then after that third year, you got to figure out what to do. And the idea being that, all right, we'll lock in a good interest rate now for 3 years. And if this is all happening quickly, we're not going to be like, oh, our interest rate's going to rise 3 years from now. We're not talking in 3 years. I think there's a higher chance that we could have a recession in, 18 months from now and be out of, in which if the recession happens, they'll lower rates. And by 3 years, we're going to see incredibly low rates again. Yeah. Now, who knows? I don't know, but I think that that's a higher probability than rates just kind of continuing to go up because eventually the Fed will hamper economic activity with higher rates, and they are the ones that can put us in a recession. Paul Volcker did it in the early 80s on purpose, and it can be a quick recession. I mean, look at the recession back in the pandemic. I mean, it was like horrible. I mean, it was horrible. I mean, again, look at those job losses were unprecedented, but we shall.
Yeah, I also like that Cushman and Wakefield rightly kind of highlights the many strong elements of the economy. We're talking about the possibility of interest rates tearing things away, but they really they're talking about how 64% of inflation is due to energy and supply chains reopening, and Cushman and Wakefield really avoids a lot of the typical alarmist rhetoric about inflation and how it may be runaway or something like that. They make a pretty compelling case that rising interest rates also, as a reaction to inflation or whatever, these rising interest rates not going to really have a damaging effect on the CRE market and could ultimately benefit them. It is it's not a lie to say that I'm an optimist, at least when it comes to this current economy. But this quote shows that I'm not alone. And it says, in Powell's words, the odds of a recession occurring in 2022 are quite low. In our words, less than a 10% probability. Play the odds. There's some more information in this report, which, again, like I said, I like it. Cushman & Wakefield doesn't put out as much reports. I wish they would, because they're all pretty good.
Well, the Indy Cushman & Wakefield, they put out the best reports just once a year.
Yeah,
maybe more than once a year, but I digress.
Leave me hungry for more.
I digress.
But they talk about how it's, first of all, it's not overnight, and second of all, a lot of times in rising interest rate environments, most of the time you actually see some GDP growth, some significant GDP growth.
Yeah, well, yeah.
So it's not a done deal that rising interest rates going to make everyone, depressed.
Well, the reason is because they're raising rates because the economy is so strong.
Yeah,
I mean,
exactly.
that's like it's like the economy is too strong, but maybe too strong. It's artificially it's fundamentally strong. I truly believe that, but it's also artificially strong and injected because of all the money printing that's been going on.
And they make that point too, the kind of implied point. They said, one of their primary concerns was economic recovery. Now that's not their primary concern. The other one, inflation.
Yeah.
So
the economy has recovered. Well, that's a good insight, Cushman Wakefield. We appreciate it. Okay, Redfin though. Nationally, asking rents were up 15% in February, while home buyer mortgage payments increased by twice. They doubled. So people are saying rents are going to go up. We're going to hear that in the 60 Minutes article or video, but not as much as your mortgage payment if you're trying to buy a home, which is making, again, like everything's going up, but renting actually is much more affordable now than buying a home. More people renting. I keep hearing it's like, I don't think rents can keep going up anymore. It's like, well, everything. I mean,
it's right here.
You can apply that to anything.
I don't know what the correlation is, but there is a lot of variation. We'll look at the individual markets between how much rents go up and how much the median mortgage payments have gone up. I think it's really interesting that rents went up at roughly half the rate of mortgage payments. Now, I'm sure that there's variation, but ultimately it seems like the shorthand for this is if you're renting if you're renting an apartment or renting housing, then your prices haven't gone up versus if you're buying one. So also by implication, it seems like rents have a lot more room to grow.
Well, I'm also wondering if if you're buying a house and if they're comparing your monthly mortgage rate went up, as in like the day after interest rates rose, compared to like, okay, that's when I'm buying versus if you're paying rent. Well, the owner of that apartment community already has a loan on that property, so like their rent increases aren't as related to the rise in interest rate. However, that being said, future purchases of apartments at higher prices because of potentially higher interest rates.
Yeah.
Well, the prices are high, and the higher interest rates means they need to increase rents even more. You'll see continued rent growth, but I think the rent growth is much more lagging than the mortgage. What your
that's a really
payment.
good point. Yeah, but even so, like I think it's a really good indicator. Again, there's probably a lot of messy factors that make this, not a direct correlation, but it's a really good indicator that rental prices have some room to grow. And I think when you look at the individual markets, it gets almost even more interesting because there's not a clear trend. I thought that maybe if you see a lot of rent growth, then you're going to see an equal amount of mortgage growth, or maybe mortgage payments, or maybe the mortgage growth was a little bit lower. But just for a couple of examples, and there's a whole list of this on this Redfin market. But the first major market that you see is Austin, and it has 40% rent growth and 42% mortgage growth. That's pretty even. But what about Newark and New Brunswick, New Jersey? They both had about 36% rent growth and only 25 to 23% mortgage growth. And it really is across the board here. Maybe if you look at Phoenix, rents were up 26% in Phoenix and mortgages were up 44.6. So it's not all even. In Portland, Oregon, rents were up 39, mortgages only up 27. So rents actually outpacing mortgages in some places.
Interesting.
I could go on, but more than anything, this really does seem like each of these markets has its own individual set of circumstances that make it harder to paint with a broad brush. Even regionally, there are some places where you're seeing mortgages kind of outpace rents, and some places where rents are inching ahead of mortgages. It's not completely the same, but generally, on average, renters are the increase in rents have been about half the increase of mortgages.
That's interesting. Now, this Redfin data, I believe it is for single family home rentals, not apartments. I think I'm pretty sure that's where most of their data comes from.
That may be the case. But I still think
it's still. I mean, it's all still correlated, and I think it's still a good example. But here, let's look at their methodology. Rent versus analysis uses data from over 20,000 apartment buildings across the United States. Okay, they say apartment buildings, not single family homes. So maybe not. The only reason I said that is just because we are often reporting on these facts.
Yeah.
And some of the percentage increases, now we're not always looking at Redfin data. So we're usually looking at other more multifamily specific data sources. But some of the rent increases were higher than we've seen on other sources that look more like single family rental increases. Again, just based on the knowledge of certain markets and certain rent growth, but just curious about that.
Yeah, just in all, I like this. I like this report. It showed me a little bit of something new, and something in an important context when you're thinking about an individual home buyer, and whether they want to buy a home or rent a home. They're probably thinking, am I going to pay more mortgage? Am I going to pay more rent? And I think this is a nice little clue. You can add this to your market analysis. Look at that spread between the rise in mortgage rates and the rise in rents, and maybe that can point to a place where it's got some potential.
I think that's always a good part of one's underwriting is taking a look at, you have to compare home prices and where those meet. And that is an indicator of demand because it's not even an option. I mean, there's at one point to say, well, there are some people who prefer to rent, either renters by choice. They can buy, but they're choosing to rent. That group is shrinking all the time. And I think it's going to even create like a subclass of renters that they are no longer renters by choice anymore. They are well off, well paid, but they're renters by necessity.
Yeah.
I mean, they'll still rent a nice luxury apartment with all the bells and whistles. They can spend a lot per month, but maybe they don't have the $7,500K in the bank ready to go for a down payment, or don't have their parents
with rising interest rates. That's going to make it even more of a hurdle.
Even more of a hurdle. And then I think you have some people too who probably could buy, who have been on the sidelines for years because they're waiting for the crash to occur. I mean, there's so many people who are like, well, I'm waiting for the crash. Well, they've been waiting for years now, and now they're like, am I really at the top? So I'm really going to wait. People are saying, oh, there's going to be all these foreclosures. It's like, well, everyone's got so much built-in equity.
Yeah. And again, like the previous point, the articles, there's some massive generational pressures that mean that housing demand, it's not going to cool off.
No, I exactly. People still either millennials are going to figure out a way to buy single family homes somehow, or they're going to live somewhere. So they're going to move into a nice apartment or build to rent. I think that's why build to rent is a great concept that is getting a lot of steam because, and what we'll get into just right now is, what is the American dream? Is it really buying a home? Is it really kind of getting a 30-year fixed mortgage? Or is it something more related to, freedom, opportunity, and choice? 60 Minutes did a segment, rising rents in the United States. They're through the roof, and we're gonna keep this on mute to talk about it. Matt, you watched it as well. I sent it to you last night. We're looking for some good content, and of course, I'm like, anytime that major media publication talks about rents and apartments, like to pay attention because sometimes they get it wrong. I mean, they use a lot of Redfin data also. Essentially, the conclusion, and they start this with basically talking about the main cause is
good stuff.
They really talk about two potential culprits when they really kind of pin the blame on one, and then another that isn't really to blame, but people like to use it as a scapegoat. So the real cause of blame, according to 60 Minutes, and something we've talked about every episode, is just the fact we didn't build enough housing. We've had all these millennials that are approaching home buying age, and we just didn't build the houses for them. In previous generations, they're like, all right, they're all in their 20s. Let's be building houses. They're going to be ready for their starter home soon. And then, so when they hit 30, kind of mid 30s, here's your nice new starter home that you can afford. We didn't build those houses. They're just, sorry, you're the largest generation. We just didn't build any houses for you. What do you think is going to happen to prices?
And even now, like if in the near term, if you scrambled, and people are scrambling to build more, it's hard to do. You can't do it because of the very pressing supply chain things that are still getting kind of untangled. Well,
as Matt Baxter, our director of construction projects, keeps telling us 2x4s are $8. They were $250 like 2 years ago.
Yeah.
And like, so you're going to go and frame something. It's almost four times, not for a full, but it's significantly more expensive.
Well, I mean, we've talked about commodities, and then there's the labor shortage. Really, it's like the prices are high, and it's getting slower too.
Yeah.
So
it slows down. It can't even deliver them on time. So in this 60-minute speech, and it's worth watching. You feel really sorry for these individuals. So this couple, they moved down to Jacksonville, Florida, and they're renting a place for about $1,000 a month, with the idea that they would buy something at some point. And their lease renewal came up, and their property manager said, "We're increasing your rents by 40%. Your rent's going to be $1,400 a month."
Is that typical?
No, it's not typical at all. It's not even typical in this crazy, market that we're in. It's happened in Austin. It's happened in various Florida markets like Tampa, I guess Jacksonville, Phoenix, I'm sure in some cases. No, more typical has been like 8 to 20% in most other markets, assuming that they're like not declining markets.
Yeah.
I think the national average was like around just under 15, like call it 12 to 15, 12 to 17, depending on your source, a national average. So
how much renewals will, or?
Well, so that's the other thing. Those are market rate increases usually that we're talking about, like 40%, 15. Those are typically market rate increases. Usually renewals, and I'm glad you brought this up.
Yeah.
Usually you don't raise rents on renewals. You're not trying to beat up your existing residents. Yeah. Typically, like what we do at our communities, it's like if you've been there, you're a good resident. We want to keep you. Your lease is way under market, paying hundreds of dollars less than market.
And this is, I think, part of that, and we get some house framing, but I want to talk about the conceptual framing that they're doing for this, because they're framing it as the story of, this 40% increase of, it's almost like a worst case scenario where you're in an environment.
It's an extreme example, but it is a real example. I've heard stories of people in Tampa of the rent doubling, going to $1,000 to $2,000 a month. Because you think of 40%, that means that there's some that to get 40%, that means that some have to be increasing more and some less, just to get to the average.
Yeah.
So that's not typical. And what I was saying on renewals, typically you're not increasing your renewals as much. It's usually a token amount. In the past, it's like, here's another $10, $15, $25 more a month per year that you're going to sign on. Not full bring you to market. Now, if you get a new lease, it's whatever the market is, okay, then it's like, okay, 40%, whatever. It's just whatever everyone else is charging, based on whatever demand is. But it's not typical just to say, hey, you're a good resident, you're a good tenant. Yeah. I'm going to charge you 40%. Now what he says is he negotiated for 30%. And then they agreed to it, and he asked why. And they said, well, that's what the market is. It's where the market is. And he was like, I don't believe that. He went and looked. He couldn't find anything else for cheaper. So that is where the market is. And again, that's what I'm saying. It's the freaking weather. It's the market. So what's his company's name again?
This is Gary Berman, CEO of Tricom.
Gary Berman from Tricom. So they are a huge landlord in the single family home space. And so they're sort of trying, and he's got even a leather jacket and everything. They're trying to portray him as kind of like the bad guy from Wall Street.
Well, even the title of this video talks about corporate landlords contributing to skyrocketing rent, which is it's about as blatant as you can be when it comes to this implicit message that they're trying to make here in this video, that it is Wall Street, it is investors that are driving up the price of rents as well as the price of homes. I think that regardless of how there's not a lot of context behind both of those statements. I will definitely keep my eye out for research that pinpoints how much of an impact investors have on the price of homes, but I don't know. I don't think it's exactly accurate.
Well, they said in this piece that corporate landlords, as they call them, big corporations, like Goldman Sachs, Blackstone, JP Morgan, that are showing are, almost like a gray capital. Right. They're saying that they are not the largest landlords in the country. It's still the mom and pops that are majority of the market, by far.
And that's the easy, and it's a fun story to tell. It's so super. You've got Wall Street buying up homes, making it hard for average Joe to put a roof over his head, making it so you can't own a house like your parents, depriving you of the American dream. Which they're going to say that in the video in a second.
And that's where it gets to, is basically these people being like, we came here to buy a home, and because Greg is saying that, basically saying that maybe the American dream isn't owning a home, and people actually are preferring to rent, which there are people that are preferring to rent. There's a whole category called renters by choice. It goes back to this couple. They're saying, no, we want to buy a home. Isn't that the American dream? Aren't we entitled to that? Like, who doesn't want that? And his counter to that is, well, you can rent the American dream, essentially, which I think is a really bad way to phrase it. But what we've said is the American dream is a marketing slogan created by the banks in order to sell us 30-year mortgages. Like, let's get that straight. It's not like something inherent that's in the Declaration of Independence that that every man will seek out his plot of land with a fence for a playground. The American dream is pursuit of our own passions, and to pursue opportunities, and to have freedom to live the life that we want to live. How we allocate our assets, whether that is allocated to a piece of dirt that we live on, or we're renting that and we own other things. Is the American dream really a 30-year fixed mortgage, or is it a lifestyle?
Yeah, I think that a lot of their argument too about investors driving up these prices is not necessarily accurate. You could also counter that with the idea that there's a lot of demand for single family homes because the prices are driven up mostly by probably home buyers. And so with that in mind,
that's the bidding war.
Of course there's going to be people that want to live in a single family home, can't afford it. And so the rise of single family rentals is meeting that demand that's there. People want to live in a house. Maybe they can't own one, but they get to live in one now because of these rentals that are coming up. I'm again, I'll have to do some research on how it actually moves the market, but absent of any research, I'm not going to really trust the idea or the story about the fat cats taking,
I mean, even 60 Minutes really made the conclusion that it was not the corporate landlord that was moving the needle. I think it's really more of a scapegoat, and because they put the blame on, I guess you could put it on investors and developers, but for them not building enough. So it's like you're investing too much now, because we're mad at you for investing too much now, but we're also mad at you for not investing enough at this point. And it's like, well, why don't you just get out of the way?
And another factor is, location. I just talked about that, about, mortgage and rent growth. You got to look for a place, people are becoming, now I don't think this is a sea change by any means, but remote work has made people newly mobile, and it's probably going, as home prices rise, especially with such a mismatch in rising home prices, people are going to factor in home prices. They're going to move to other places where it's cheaper to live.
Absolutely. We were touring a property yesterday, and new construction, still under construction, really. In their units, they built little work nooks for you can build a little desk and work from home.
It's I don't think I don't think that remote work is as transitory as
I think so too. I think it's a lot of flexibility in this whole hybrid environment makes quite a bit of sense. Well, you can watch this actually watch this 60-minute video, not just hear us blabber on top of it. You can find it on YouTube. It'll be on the comments down below. Matt, this was a excellent episode and rendition of the Gray Report. Where if I'm an aspiring real estate investor interested in multifamily, how do I stay up to date on all this stuff? What do I do?
Go to greatcapitalllc.com/newsletter and sign up for our newsletter.
Yeah. It's true. greatcapitalllc.com/newsletter. That's going to get you all these reports just delivered right to your inbox every single Thursday at 8:30 Eastern. There's a couple other ways, right? I mean, greatreport.com, it's a great source. You got the podcast. You got to subscribe to the YouTube channel. Speaking of that, make sure you're giving us a like, commenting, and subscribing to the YouTube channel. That really helps us out. It gets the YouTube algorithm really cooking, and it just shows us that, hey, you guys are listening and maybe appreciate. But if you don't like what we do, definitely tell us in the comments because that helps us too somehow. Matt, appreciate this is a great report. Everyone stay safe out there. Let's make some really smart decisions. See you in the next one.